What is going on, everybody, and welcome to another weekly update. And what I like to do in these videos is provide you guys some upcoming earnings, some upcoming events to get you prepared for the week ahead. If that sounds like something you're interested in, consider subscribing, as I am now doing current events and I'm blogging as well. So you can catch out the blog down in the description. So, as per the usual, we're going to go ahead and pull up our handy dandy scrap sheet here because we got some things to go over. Now, as you can see, there isn't a bulk load of stuff. I didn't add a bunch of details when it comes to the earnings, but there are things I want to talk about and why. Again, earnings is going to be one of those things that you really need to be focusing on and paying attention to, because you're going to get all the information you need to make your next moves from earnings and where the market's going to be going over the next 6 months, or until at least the next quarter. Something I've talked about every earnings mode is you're going to get in that window, which we are currently in, as we are getting prepared for the next essentially Super Bowl week of earnings, as to understand that it's initially the first about 3 to 4 weeks of an earnings cycle that are going to be the most impactful. And then outside of that, once the stock is run up, pre-earnings pump, and then you may get about maybe a week after earnings if they do well. And then after that, the stock starts to naturally sell back down and go back into the cycle and sells off for about 2 to 3 weeks after that. So with that being said, as of right now, this past week, we have had Tesla and Netflix in Bank of America. Now, what going into this, my expectations were not high, especially with Tesla. Their margins have been decreasing quite a bit over the past couple quarters, so much so they've been reducing cost on their vehicles. Now, coming into, I also did a video on Tesla this past week. If you haven't checked that out, I highly suggest you check that out. I got into more detail on what went on during the earnings call and kind of what I was expecting out of Tesla. But ultimately, in short, I still believe very much in the company. It is hard times. Now, the market really doesn't care about short-term hard times. It's going to sell off, right? That's just the way it is. But ultimately, if you're looking for an investment, it's still a very good investment. Just understand that there will be struggles ahead. But again, I will point to that video because that video goes more in depth about that and kind of what I'm looking for there. But anyway, over the past week, we had Tesla earnings. They missed on pretty much everything, and as expected, right? There, you have to understand that, again, the current state of the economy, selling vehicles is not going to be easy at all, and especially for someone like Tesla that is very efficient in their production of vehicles, is still going to get hit. And this is why they create an ecosystem. This is why I talk about some companies that create an ecosystem around them, so they build out essentially all different kind of products that span across different industries. So if one goes down, essentially they can sustain themselves. Tesla is a big energy company as well. They made about, I think it was $500 million just off of energy alone. And then you also have the fact that they're aiming heavily on AI. A lot of these tech companies are, because Tesla is also very much a tech company, and they talked about real world AI and that they are advanced. And I talked about that as well in the video. But those are the kinds of things that you need to be paying attention to, especially going forward. This is also why the Big Seven have been doing so well, because it's all about innovation. Kathy Woods points this out a lot. And given times like this where inflation is high, people want higher wages, which is also a double-edged sword, because on the same token, if they increase your wages, all that's going to do is create more inflation. So they cannot do that. The company will not remain profitable, and you will create more inflation and then make it even more unaffordable for people. So there is a fine line between a happy medium between everything that there is. So with that being said, Tesla, again, missed on everything. I think Tesla is close to being more positive with margins. I think we are close to that. I think we probably got another quarter of hard hitting to get through. I think we might see some positive change in Tesla after the next earnings. I think if it's not next earnings, I think it will definitely be in Q1 potentially of that year. And again, they're very innovative, so they would be one of the first ones to get ahead of the track once this thing starts turning around. Yeah, Netflix, they missed on some aspects themselves and starting to increase rates. Again, with high inflation, they are trying to price gouge the consumer, but again, the consumer has no money. So that's pretty much what it has there. And something I've always talked about, when you go through hard times, cheap entertainment is going to do well. Now we've seen this during the pandemic. People didn't have any kind of entertainment, so Netflix did really well. It crushed it. And on the same token, you're getting into an environment in which it's expensive to do anything outside of the home, so people just stay home and will watch movies or whatever the case is, right? People have already been kind of programmed because of the pandemic to kind of fall back into that, but just because things are so expensive. And then you have Bank of America, and they had like $136 billion unrealized losses. Now these are something that we've seen across all the banks, is and something I talk about all the time when it comes to expectations for banks. Yes, they will blow them out of the water, but because these books aren't brought to market, you don't see the unrealized losses that are absolutely absurd, which would make you want not to put your money in any of these banks. And why a lot of money has come out of banks and gone into other assets, right? This is why people are taking the money out of banks and purchasing physical assets, right? Whether that is houses or gold or anything like that. That's why you can see the demand spiking, because people are very uncertain about the current economic system, especially the debt-based system that we're currently running, given that there is no House Speaker, given that there is no debt ceiling anymore until a new president comes in office or gets reelected. And then on that same token, we've just been burning through cash like crazy while also sending billions of dollars to Ukraine and billions of dollars, potentially billions of dollars to Israel as well, only to essentially put us in a stance of war to fight over resources because things are bad. You have to understand this is why war happens, because we need more resources, because our GDP is in trouble, because again, inflation's running away, spending is absolutely absurd. Again, wages can't keep up, so what do? You go essentially steal resources to bring down inflation for your country, and that's essentially what we're aiming for. And so with that being said, yes, so wrapping that back around, Bank of America is doing bad, right? All the banks are doing bad in general. And again, this is just a taste. We are coming into Super Bowl week, where you're going to get a lot of the big industry leaders, especially in tech. So the big seven. So the market is trying to price that in and understand that they're expecting a big move this week, because there's a lot of weight given in this market this week. So just keep that in mind. There was Powell on Thursday as well. I had briefly mentioned this. I don't know if I had actually talked about this, but he was speaking in a little bit more of an open kind of forum. He hit on a lot of the same things. He was really surprised about the strong economy. And again, I think I want to point this out again, is I think that it's more so, they don't trust the current system. I think everybody in the back of their mind has never fully trusted it, and I'm sure to some extent, they've been told throughout their life that it's a debt-based system and that it's horribly bad. And at some point, I think people have again lost that trust, and so people will go out and purchase other things, whether that's like I talked about, physical assets, whether that's owning a home or high-end sports vehicles, right? They hold value extremely well, or luxury items, or gold or silver, anything like that. People are purchasing those things to hold value in case the dollar does go under. They have something they can sell into whatever the current currency is. So this is why that may be so strong as of right now. Just essentially alluding to the fact that next year is going to be bad. Now, it's not saying this is why the stock market is so different, because the stock market will price it in, which it's looking like it's starting to price it in. And when we get to the charts, that it's going back to that 4,200 level, which I said was a very key level. So if it breaks that, we could start pricing in a recession. So ultimately understand that I think the strong economy that is seeing in the data that the Fed are seeing are those people that are moving cash to actual tangible assets that they can transition over to other currencies. So I think that's why we're seeing a strong quote unquote economy right now, because you're seeing that transition, whether it's in crypto or, again, whatever the case is. Now they're still targeting 2%. That's not going to change. That he said essentially was saying that it's still going to lead us to higher for longer, higher rates for longer. They're projecting that they won't start cutting rates until late next year. I think I've talked about this before. I think it's going to happen a lot sooner than everybody is anticipating, because I think all we have to do is start pricing in a recession, and it looks like we're doing that now. If we can break that 4,200, I do believe we start pricing in a recession. Again, that's a very key level. If we do break that, then I would think in my mind this is the recession price in, and then there will be no more rate increases. We'll just hold rates. We only got 2 more left here. We got about another week before the next monetary policy, and then we got 1 more in December, and then we're in a new year. So I don't believe they're going to increase it anytime soon. I think, again, there's still a very latency effect when it comes to interest rates and maturity of loans. We don't really know where that is quite yet. We won't see the full impact of that until months later. So we still haven't, even though we've paused for the last 2 monetary policies, we still haven't had that full effect just yet. And we won't see that probably till roughly around spring or summertime of next year, the full effect, if nothing happens, right? And this is, again, if nothing happens in next year. There's a lot of loans that are coming maturity. This year we don't have much more left, so we might not get a full impact of that. We just don't know yet. But ultimately, again, and we're starting to see the effects of that, because what we're seeing is Walgreens has filed bankruptcy over the last week as well. That's something else. And then you also had, you're getting a lot of layoffs. LinkedIn laid off a lot of people, and it's happening across, again, the broader scope of all industries and not just tech, although tech is getting in its next wave of laying off as well. So keep that in mind. This is what we talked about. These are the stages. I forewarned everybody on these stages that are going to happen. Is you're going to start getting massive layoffs that continue to happen and start affecting smaller business. And again, that's where it's going to hit the core and the foundation, everything that's going on. You have to understand that people right now are sitting on a 2% interest rate, so they can continue to spend and shift their money around into tangible assets because of the uncertainty. But on the same token, if that 60% of the small businesses get hit, what's going to happen is they're going to get laid off, and then they're going to be forced to have to sell their home. That is what the Fed is waiting for. The Fed will hold rates where they're at until that happens. People are ready to buy homes. They're not afraid of the high interest rates, but the housing prices are ridiculous. So once more supply comes into the market, that will drive down the prices of a lot of these houses that are just absurdly gone up. And you can see this across any board where people have tried to flip homes. They bought a home, say for $100,000, and then 6 months later they're trying to sell it for $200,000. How did equity grow $100,000 over 6 months? It doesn't. But some people are actually able to flip them. They were able to flip them last year, but this year it's changing to where they can't flip them. And so we're starting to see where that pullback down to reality is starting to happen. Now, when I talked about the housing industry, that is going to take a long period of time to play out. So you have to be mindful of that. Again, the stock market will move way before then. The stock market will price all this stuff in, a recession in, before, you will see this latency effect happen in housing. You'll see a pullback in housing. You will see a pullback in housing because of the fact that wage growth is nowhere close to the spending that we currently have. So you will see in the prices that are currently going on. So you will see a correction at some point. Probably the next year or two that will happen. Again, you have to give, again, the housing industry is very slow and lags quite a bit compared to the stock market. The stock market is very efficient and can price this stuff in quickly over a couple months, and then that recession would be priced in, and then you would get a recovery mode very quickly in the stock market before you would see that again in the housing market, and companies would recover a lot faster. But again, you are destroying demand. When you destroy demand, it's going to go away for a while, and then when that demand You try to stimulate that demand by giving more money, but you have to understand that you crush demand, so people have to build the confidence back that things are going to be okay, and that takes a while depending on how bad you essentially you smash demand, right, and kill the consumer off. So with that being said, that's what we're looking at there. Total excess savings is now down to 2.3 trillion from its peak of 200 billion. Bottom 80% of households currently have zero excess savings remaining. That's how bad it's getting. It is getting extremely bad. So with that, let's look at the upcoming week. Again, there's not going to be a lot going on this week. It's all about earnings. This week is Super Bowl week. You're not going to get a lot of scheduled events going on. There is core PCE on Friday at 8 a.m. Eastern Standard Time. Again, it's not going to really move markets, but if the markets are already selling which one way or the other, it can add to more of a sell-off or add more to a bullish push if that's what the case is. Although the current charts don't look bullish at the given moment. Next monetary policy is until the 1st. Core inflation is on the 14th of next month. Upcoming earnings. These are the heavy hitters. Again, these are the ones I am watching. There is a lot of earnings this week, and these are the primarily ones I'm watching. Obviously, very heavily focused on the big seven. We've already had Tesla. Now we're starting to get into some of them, and then we got Apple, I believe, next Wednesday or Thursday next week. And again, Apple itself holds like 7% of the index. So right now, we're going to get that big taste of what's currently going on and then move into the next one. So we have Microsoft on Tuesday, Google on Tuesday, and then Visa. I have Visa listed because it's not Visa won't impact the market, but Visa will give you good insight into the delinquencies and current spending as that's continuing to go up. So we want to continue to watch any kind of credit cards and see where they're headed. On Wednesday, we have BA and Meta. So you have a big value play Wednesday morning. Then it's followed up by Meta, which also holds a lot of weight also in the index. I believe it's the second on the index as far as the amount of weight it holds. So that is on Wednesday night. And then on Thursday, you got UPS. So that again is not going to really shift the market in any direction, but UPS is good pulse on the market and see where they're currently at and what's going on. Again, they push a lot of products out. They're transporting. So if that is getting hit hard, that shows you that the demand isn't there. So this is why other companies like all tech companies are doing well, because their overhead isn't as bad as something like an Amazon, which they do have one side that is very tech heavy oriented, which does help a lot, but they also have another side which is more of a retail sale kind of thing, and so they can get hit harder there. But nonetheless, we have Amazon and we have Enphase. We got energy on Thursday as well, which energy's taken a huge blow over the past week as well. So again, a very big week. This is just some of them. You also have like Chipotle, McDonald's. You got all kinds of industries reporting this week. But again, I'm looking at the big seven as they have more weight over the index, and so they will essentially really. This week will be a perfect week to really gauge the pulse of the market in this week, and this is why I call this essentially the Super Bowl of earnings, because it is ultimately the real pulse on the market, and that's splattered spontaneously on all different kinds of other weeks where we just got a taste with Tesla and we saw it was bad. We'll have to see again when we start getting into cloud computing. They don't have as much overhead, so we really have to see how it goes there. Ads are something else big to watch this week, especially with Google, because are people spending for advertising? That gives you a big gauge on where the consumer is at as well. And again, a lot of these retail sales have been getting hit hard. You have to understand that people aren't buying those particular things. The purchases that people are getting now are very strategic because they're uncertain of future events, especially global conflict that's going on as well, on what's going to happen with our current debt-based system. And so people are purchasing other assets in case something does happen. They can at least trade that for whatever the current currency is. So. And then as of the watch list, like I always put these up here. You can see a huge uptick, SPX. Again, if you follow this channel, you know it's roughly around like 60 is a good pace as far as SPX goes, but it's up to 94. So they're trying to price in a lot on SPX. I noticed this on Tesla. Tesla was up, I think it was 18 last week because of earnings. Now that has been adjusted back down to 13. Tesla might be a better play this week, obviously a better play this week than next week, to see if it continues to sell or if there's a bounce this week or whatever the case is. Tesla would be ideal to be watching, as a lot of that pricing is taken out of there. BA is, they report on Wednesday morning, so they priced in a lot. And again, if you watch this channel, you know BA hardly moves from 7. And so the fact that it's moved from 7 to 11 means they're pricing in a lot, and it's been selling off pretty heavy. Again, it holds a lot of weight on value. That's why I bring up BA all the time. I don't like to trade it, but it's a good value. It's a good pulse on value stocks to see where it's at. So watching that there, JPM hasn't moved, still sitting at 4. All right, so let's jump into some charts here now. Now, as you can see, SPX is sold off. We had a nice bounce off that 4,200 to roughly almost that 4,400, and then have since just been selling off heavily. Again, higher low here. As you can see, this downtrend continues. Again, big key area here this week is going to be the 4,200. If we cannot hold the 4,200, we are going much, much lower. And something we've talked about to this point, which I sound like a broken record, and we can even look on a higher time frame here just to kind of look over last year, as from this peak of 4,200, and we're starting to sell off again. If we break that 42, roughly even around here too, that between that 42 and that 4,100 are very critical. If we do break that, we're going straight back down to the 36. Again, this area will be very interesting in my opinion. It could be a higher low, so you definitely want to watch. We could make it only down to the 38, so that'll be something to watch there. But if we come anywhere close back down to that 36, rightfully so, we could very well make a newer low. And again, when we started up here last year, again, remember that we talked about the average recessions about 43, roughly around 43, which is around 3,000, which again I think is quite low, but nonetheless that's average of a recession, and that's from the peak in itself. So we will see if that is true or not. Again, as you can see what the price in, or essentially the printing of 40% of the money supply does, right? And to think that this thing is just going to keep going up, it's not going to happen. Like this huge move here needs to be taken out. You cannot have this, right? You have to pay for this. This is printing 40% of the money supply. So you have to have a correction. 32, if I'm not saying it's going to hit the 3K mark, but if you took out that price, you could equalize roughly around here, around the 35 or so, which we attempted here. But I think we could maybe even go to 32 potentially. Again, it all depends. This is why we have key levels marked off to see if that happens. But I do believe this needs to be taken out and fixed because of the fact that that printing of 40% of the money supply, the Fed want to fix this. Because of what was going on with the pandemic. So to be able to fix that, it needs to normalize roughly somewhere around here in that 35, maybe even the 3K mark, 3,200 mark. But we'll have to see how that does play out. Again, I'm not trying to predict it going that low, but a recession on average is about 43%, and roughly it could be, so it could be more. It could be even 80%. We don't know. But ultimately, it's not going to go just straight down. Pricing in a recession takes a little bit of a time. It's not a crash, although a lot of things are lined up to potentially crash if anything does happen. So this is the problem when you're dealing with all this constraint of high interest rates and no liquidity, people out of savings and everything. You're waiting for a major event's going to happen, and the Fed are aware of this and they're trying to make it happen. But again, the demand going up, and again, it could be related to that of which people are purchasing things in preparation for what's about ready to happen over the next 6 months. Because I do believe whatever's going to happen is going to happen even sooner than that. I think it's going to happen maybe in the next 4 to 5 months because of the fact you got Bitcoin halving right around the corner, and then you also have the Bitcoin spot ETF, which people are trying to get approval for. That's going to be a big move, and institutions want to be on the crypto side of everything before that happens. So I think sometime between now and roughly February, March, that should occur during that time, and now would be the ideal time for that to happen, as things are getting are definitely in the pressure cooker as of right now. So at any given moment, that can happen, especially during an earnings cycle. Some news can drop, and so that's kind of what we're looking for here. Especially since there's been some heavy selling coming down. Again, if we can break this level, 4,200 big level, and then again at 41 would be the next big level. If we can break that, then it's pretty much a free fall back down to 3,500. So those are what we're really watching coming into this week and moving forward. Now, let's take a look at Bitcoin here. Bitcoin, it's been playing this level very well. So essentially between the 25 and roughly that 32, getting pumps and dumps. Very strong wall here. I do expect this to come down one last time. Again, institutions want to buy before that spot ETF. So I think accumulating anything around that 25 and expecting it to go potentially even lower than that. Again, not financial advice, but definitely watching these levels to see if it's breakout. The fact that it's been holding very well is definitely a very, very good sign. Despite everything that's been going on, Bitcoin has been holding very well, and people are kind of hedging against inflation, hedging against the de-dollarization potentially happening. So really watching that closely and seeing what plays out there. Again, if it does break that 25, I expect this thing to go quite low, potentially back down to the 15 if it can't hold that. So eventually this is quite a bit of consolidation that's going on here. So whatever move it does have out of here will be very explosive. So just keep that in mind. Then you also have oil. Oil is going to be something big we need to be watching because of what's going on in the world right now. It hit 95, so that's something we need to see if we can. It's actually an ascending wedge, which means this thing should sell back off again. But if this thing breaks over 100, again, that's going to be a huge problem. This is also why we've weaponized the dollar, because OPEC has been pushing up oil prices. So to try to combat that, we've been trying to weaponize the dollar and increase the value of the dollar to be able to do that. But we'll continue to watch and see how this does play out. Again, I think the true war that we're going to get at some point is going to kick off next year. Then from that point, things are going to get quite hairy, I believe, next year. So again, and it's all about resources, and oil being the primary one of them. So we need to be watching what goes on with that moving forward. Let's take a quick look at the bonds too. Again, another big thing I think is extremely important. It's getting to historically low levels. Again, this is not a good sign. Nobody wants U.S. debt, like, period. Not right now. Not with everything that's going on. And so, especially with the de-dollarization and everything, the fact that you're almost at lows, some of the lows we've seen in a very, very long time. This is on a 20-year too as well. People are buying a lot of bonds in anticipation of this thing popping. Again, not financial advice, but if you're trying to play bonds, the best piece of advice to take on doing that is waiting until the Fed actually cuts. When they cut, that is your cue to look at bonds. Until that happens, you could be riding this thing down even further. This thing could come down a lot more. And to think that it won't just because it's sold off, the market can prove you wrong many times. This is why confirmation is always very key, because you don't know how long this thing can drag out, right? You think it's bad now, they can continue to drag it out as long as they want. They made that very well aware, the Fed have, that they're going to hold rates for a long period of time, but until they start cutting, will this thing start shooting back up? So you have to wait for that move to happen. When that announcement happens, then you need to get on it as quick as possible, because that's going to essentially shoot the bond market up when that does happen. All right, now Tesla, bad earnings. We broke this wedge. Again, if we can't reclaim roughly that 220 by this week, this thing is going to start selling off heavy. Maybe it's going to start pricing in, again, lower high. If it's going to start pricing in a recession, it could go beyond this $100 mark. Could be. You have key levels here that you need to be watching. First, we got to break 200. Then we got roughly around the 172 mark, and then you have here the 100 mark, and then if it drops that, it could be a free fall down to potentially the 50. Again, you have to understand there's been some really historic levels that have taken wiped out 80% of stock prices on some of the best stocks like Amazon. So you have to be well aware it's a possibility, and that's what we try to deal on possibilities. Will it happen? I don't know. I'm trying to determine what the demand is, and the only demand I'm seeing is people trying to transfer 401ks and everything else into other assets outside of cash in case something does happen to the currency, since that is a big scare as of right now. So I don't know. Maybe it could be 80%. I don't know. But we'll watch and we'll see, and we'll watch the levels and play the levels, and not too. And this is why I don't like going too far out, 6 months out, because we don't know. A lot can change over a night. So to think that it's going to be this way in 6 months, we don't know. They talked about a crash after the 2008 financial recession was crisis that was priced in, right? And then it didn't. It made that crash, and then it recovered, and it wasn't smoothest recovery, but it recovered. And it's just the same kind of thing, right? Like we're gonna price in a recession, and then at that point, um, there's going to be much more after effects. And so you have to be, when you see, again, not financial advice, but when you see the red, you need to be buying into the fear, because that's when nobody wants to buy. And then when it starts, um, again, not financial advice, but full out buy for me if Tesla gets that far, because again, they are, anything Elon puts his minds to, he becomes the industry leader in, pretty much. In the fact that his sights are focused on AI, considering AI is what's going to kind of pull us out of this, I think he will be the industry leader in AI, and they do have the best real world AI data out there and algorithms, and uh, that can lead that industry, as they've had everything from their cars, from all the data that pulled off their cars, to be able to do that. And so you have to have a good solid training model, which a lot of these places, they don't have that. They don't have any of the amount of training data that Tesla has, not even close. And so they are just pulling themselves away in another industry. So just be mindful of that. And so again, very, very good company moving forward, especially in the rough time. So you have to look again outside the cars. Cars, short term hit. Yes, I do agree there will be a short term hit. But in the long run, the next 5 to 10 years, Tesla will do extremely, extremely well. So let's look at Palantir. Drop this back down to the daily. Palantir has been doing really well. Again, waiting on earnings roughly around the second. So we got another week before that happens. Kind of just playing range here. Want to see if it can break the 14. If not, it could skyrocket this thing back over 20. Again, if it's incorporated into the SPX after this earnings cycle, that means institutions have to buy. So at that point, this thing could start creeping up, even though everything else may be selling off. So I'm really watching this one closely. Really want to get this back down below 14 again, and then see where it goes from that point. But another good one, especially with the current, what's currently going on in the world. This stock could definitely be, this defensive stock could definitely be a huge, it's not just a defensive stock, but because their software does a lot, but their AI is one of the best, and they have a lot of the government access that none of these companies are even close to getting, and it's very hard to achieve. And so this is, again, one of those ones I want to be buying into on this pullback here. So we'll see what happens with that. And then let's take a look at our usuals. Again, BA came a massive sell-off. It took forever for this thing to play in this range, and then it's just buttering these levels, which is not a good sign. So I've talked about this gap fill. I do believe this is going to be down by 127 again at some point. Again, it's going to play heavily on the index for value stock. It holds some of the most weight for value. And so when that starts pulling that down again, and we start seeing all industries suffer, it's going to be a huge problem. And that means that you're going to get a bigger move to the downside of all industries. And this week is ideal for that. So if you see a bunch of companies doing bad, that's going to pull down all industries, and then that could potentially start leading into more of that price of recession and more of a break of that 4,200 level. So BA is definitely one you're going to be watching this week. JPM, Still roughly holding that 41 mark. Again, if it breaks that, aiming for that 127. If it bounces for some reason, the 156 would be where you're shooting for. Now, with that being said, you have ones like Goldman Sachs who've been playing this range. You had this fake breakout, and then you have one last retest, and now you're selling off from a break below. So this thing could start getting pretty nasty with Goldman Sachs. So watching this to see how well it did. And again, it beats expectations, but you have to understand there's more beyond and what's on the books and not brought to market, right? And when people realize what these unrealized losses are, that is a huge problem, because we're not talking about little millions of dollars. We're talking about billions of dollars in some of these, and that's a huge problem. So, well, we're shipping off billions of dollars to other countries, but so we have to really watch and see what happens. But aside from JPM, all these other banks are doing horribly bad. Bank of America broke that back down below this $27 or $28 mark, so continues to hold below. It's going to go lower to potentially 23, and see what happens there. But that is pretty much what I got. Again, this week is going to be big. We already getting a good taste of what's going on. You still have to remember there could be downgrades on banks, which I'm looking forward at some time. We start getting more into regional banks and stuff over the next coming weeks. You're going to get more information. Again, this whole roughly about a month and a half, you're going to get good information. The market will move off of the first 4 weeks. Then the 2 additional weeks, or you might get some additional information from banks, regional banks and stuff like that. And then from that point, the market will make up its mind. That will take us beyond essentially monetary policy, and it will put us right in the government shutdown again, which could be a very critical time. Government shuts down, we're not going to get that important data that we need. And so these are other things you have to take in consideration when you're looking and trying to gauge what's going to happen over the next 2 months, right? Like I try to keep everything within a 2-month window. I try not to expand beyond that, because again, it can change very much and very dramatically. And then that's pretty much where we go from there. So again, this is the dip to be watching. This is the dip to be buying. None of this financial advice. Manage risk, and I will see you guys on the next one.